Being financially independent is not just a goal, it's a reality that everyone can achieve. However, with all the complicated terms and sudden shifts, the stock market can appear like a scary forest. Sound familiar? I've been there too. But fear not. With the proper guidance, you can confidently navigate the market and unlock its growth potential. So in this video, we're breaking down stock market investment into easy steps. We will explore the tips and strategies to ace the field. You'll see it's not scary. So without further ado, let's get right in. Number 1. Get your finances in a row. The first thing is to understand your income and expenses. Track your income from all sources and meticulously list your outgoing expenses. Tools like budgeting apps or spreadsheets can be valuable allies in this process, providing a clear picture of your financial landscape. Next comes tackling debt. Prioritize high-interest debts first, chipping away at them with dedicated repayment plans. Every dollar saved from interest is a dollar freed up for future investments, like a valuable piece of new sailcloth, strengthening your financial vessel. Building an emergency fund is also important to pack a life raft. Aim for 3 to 6 months of living expenses to weather unexpected financial storms. This safety net provides peace of mind and prevents resorting to quick fixes like high-interest loans during challenging times. Also, cultivate the habit of consistent savings. Aim for at least 10% of your income, but even smaller amounts increase over time. Consider high-yield savings accounts as secure harbors for your financial reserves, allowing them to grow steadily. Additionally, consider automating your savings and setting up regular transfers to ensure consistent and effortless growth, like planting seeds for a future financial orchard. Investment is also necessary to gather up some good amount to invest in the stock market. Only invest money you won't need in the next few years. A practical way to do this is through disciplined budgeting. The 50-30-20 rule is a nifty tool here. Let's break it down. Take your post-tax income and slice it up. Half of it goes to your must-haves: rent, car, phone, the basics. 30% is for the fun stuff, your wants, dining out, hobbies, subscriptions. The remaining 20% is the golden slice for savings and investments. If you channel this portion into investments, you're giving your portfolio the time it needs to grow. It allows you to contribute sustainably over time. Number 2, find out a broker. A broker can be a trusty guide if you invest in stocks for the first time. You need someone who understands your goals, fits your style, and doesn't charge a king's ransom for taking you on this adventure. Opt for a broker that provides educational resources. Learning about the stock market is an ongoing process, and having access to tutorials, articles, and webinars can significantly enhance your understanding. Keeping costs low is crucial, especially when you're starting with a modest investment. Look for brokers with competitive commission fees and no hidden charges. Before you start searching, understand your needs. Are you a hands-on investor or more of a set-and-forget type? Different brokers cater to different styles. Take advantage of online reviews. Real user experiences can provide insights into the pros and cons of various brokers. Pay attention to reviews from fellow beginners. Compare the fees associated with each broker. Look not only at commission charges, but also consider account maintenance fees, inactivity fees, and any other costs involved. Different brokers offer access to various financial instruments. Ensure that the broker you choose provides access to the stocks, ETFs, or other assets you're interested in. Number 3, compounding is the secret. Now, suppose you've planted a tiny seed in your garden. At first, it's barely noticeable, but as time passes, it grows into a sturdy tree. The power of compounding in the stock market works a lot like that. When you invest money and earn returns, those returns don't just sit there. They start earning their own returns. It's like you're money-making money babies. As the years pass, these money babies grow up, and soon, you have a financial forest. The longer your money has to grow, the more powerful this compounding effect becomes. It's not a magic trick. It's the simple idea that your money can earn returns on the original amount you invested and the returns it has already generated. So, if you're thinking about investing, remember that the earlier you start, the more time your money has to grow, and the mightier the compounding magic becomes. Number 4, diversify. Diversifying means spreading your money across different types of investments instead of investing all your money in one company or stock. Why? Remember the saying, don't put all your eggs in one basket? It applies perfectly to the stock market too. Imagine if you invested everything in just one company, and then, well, things went south. That's why diversification is your friend. It's like spreading your investments across different industries, like tech and healthcare, or even different countries, like the US and Europe. This way, if one sector hits a rough patch, the others can still keep your financial feast going strong. Remember, diversification isn't about guaranteeing success, but spreading your risk and giving your portfolio a safety net. Number 5. Understand terminology. Understanding basic numbers like market capitalization, the total value of a company's outstanding shares, and the price-to-earnings ratio, PE ratio, which tells you how much you're paying for each dollar of a company's earnings, can be your compass in the market maze. Knowing how interest rates affect stock prices gives you a weather forecast so you can adjust your sales accordingly. Remember, just like the sun and rain both play a role in a healthy garden, the market's ups and downs are part of the journey. Number 6. Choosing the right company. You should seriously consider your options before deciding which company to invest in on the stock market. Be sure to check the company's and management's track records before making a final decision. Industry expertise, personal conviction, and compatibility with investing strategy should guide your focus. Before you invest in a company, get to know it. Understand its business model, its products, and its competitors. Look at its financial statements, those numbers that tell the story of its health and growth. High margins, meaning the company keeps a good chunk of its revenue, and consistent growth are signs of a healthy business. Verify the company's stability and growth by reviewing its financial reports. Find out what the company has in store for the future. Much like a sports team's strategy, you should consider both your financial objectives and your values when deciding which company to invest in. The key to long-term success in the stock market is a well-balanced portfolio. Number 7. Starting small and smart. Don't be intimidated by all the financial jargon. Begin with simple steps. Look at annual reports, those detailed stories companies tell about their performance. Learn to identify businesses with good margins and promising growth, like a young apple tree with plenty of buds waiting to bloom. Take inspiration from giants like Apple, a company that has thrived through innovation and smart stock buybacks, strengthening its financial position and rewarding its investors. Number 8. Taking action one step at a time. Now, the most important step is to take action. Don't let analysis paralysis hold you back. Start with a single investment if that's what feels comfortable. As you gain confidence, gradually increase your portfolio, guided by your research and long-term goals. Remember, even the tallest oak started as a tiny seed, nurtured with care and time. The stock market is a dynamic ocean, offering waves of opportunity. Stay alert, but don't be impulsive. Learn to identify promising trends like the rise of renewable energy or the growing demand for healthcare services. But remember, patience is key, like a surfer waiting for the perfect wave. Don't jump at every ripple. Wait for the swell that aligns with your investment strategy. Number 9. Reinvest. Don't spend dividends that companies sometimes pay. Reinvesting those earnings allows your portfolio to grow organically, fueled by the magic of compounding. Over time, those reinvested dividends can turn into a significant portion of your wealth. Investing is not just about numbers and charts. It's also about your personal goals, your risk tolerance, and your emotional well-being. Don't let fear or greed cloud your judgment. Stick to your plan, and don't be afraid to adjust it as your circumstances and the market evolve. Remember, the stock market is a tool, not a master. Use it wisely to build a future that aligns with your dreams and values. Number 10. Be a rational investor. The stock market can be irrational, sometimes acting like a moody teenager. It might overreact to news or ignore promising companies altogether, but don't let its tantrums throw you off course. Remember, the key is to be a rational investor, buying low when the market is gloomy and selling high when it's feeling sunny. In 2024, dominating the stock market isn't about amassing wealth overnight. Achieving financial independence requires a methodical approach. You can transform your investments into a verdant garden of wealth, brimming with the possibility of a life of independence and financial stability by grasping the power of compounding, learning the language of companies, and riding the waves of opportunity. Are you also a beginner looking to get started with the stock market? Let us know if you have any queries in the comments section below, and don't forget to subscribe to the channel. See you in the next video.